two types of policies I'm going to talk about in terms of basics and nuts and bolts, as well as areas of disputes, are the D&O insurance policies. This is coverage for directors and officers, as well as companies under some circumstances, and professional liability insurance policies. These policies are specialized policies covering alleged errors or omissions in professional work as a general matter. That would cover what we've been hearing in terms of the lawyers, accountants, bankers, etc. Starting off with D&O insurance, the jargon here is the side A, B, and C aspects of this policy. There are three coverages basically in this policy. The first coverage insures directors and officers when they are not indemnified. This comes up more rarely than the side B policies, but it would come up, for instance, where a company cannot indemnify a director or officer, for instance. Could be a bankruptcy sorts of situation, a derivative suit type of situation. There typically is no deductible on the side A coverage under the D&O policy. Side B coverage is what usually is being looked at here. That insures corporations when they indemnify the directors and officers. This usually comes with a deductible. The third side of these coverages really just came about more recently, maybe in the last decade or so, is side C, covering a corporation for certain types of direct liability. The side C coverage has prevented what used to be a hotbed of disputes. There's still some disputes, but hotbed of disputes in terms of allocating a settlement when it was both the company settling and the directors and officers. This is usually written to cover securities actions and isn't necessarily all types of coverage. This is called, in the jargon, is called the entity coverage of these policies. Distinctive features of a D&O policy, these are written as claims made triggered. That means that they cover claims brought within the policy period. That's distinct from an occurrence-based kind of policy that's triggered when the accident occurrence happened, when the injury happened. These are, again, all focus on when the claim was made, and that's important to some exclusions and so forth. It's very important to notice that we'll get to. Second feature, these policies typically cover defense costs within the limits. So the pool of limits that are available under this coverage for your settlement, for your judgment, is the same pool that's available for your defense costs. You're going to be drawing that limit down with defense costs. This leads to some very important consideration and dynamics in terms of defending the case, because you just have the one pool of money. It's different from a lot of general liability policies. The other feature is the insured will defend the case and the insurer has consent rights. Again, different than a lot of general liability policies where the insurer is undertaking the defense and actually hires the lawyers and does all that. But there's the insured controls the defense, but the insurer has important, what you think of as oversight rights. And there's several places that's actually very important. One is when the insured selects counsel. That's subject to the insurer's consent. Some insurers will have their own panel list that has to be drawn from for the hiring of defense counsel. The insurer also has a right to consent to the settlement. It's not going to pay unless they consent to the settlement. We find that particularly in this D&O market, the insurer players are very sophisticated. It's a small group of companies, AIG, Zurich, Excel, Chubb are usually the players that you see. And often typically you'll be dealing with a sophisticated in-house lawyer as the claim representative who follows this kind of litigation and is quite savvy in terms of playing a really strong role in the case.
And if I could just make one observation here, as Ann indicated, the market, the people in the market writing this type of insurance, or the companies, are relatively limited to a sophisticated group. This is this area of, or this type of coverage has seen fluctuations over the years from a limited number of people writing it to an increased number of companies getting in that business, and then as claims rose and costs, you saw market constriction. There was another series of market expansion, and now we're back, I think, in a more restricted period.